Gold and stocks both just hit all-time highs, which, by the way, isn't supposed to happen. They aren't supposed to both be going up at the same time, and they aren't supposed to go down at the same time either. And the fact that they have now reached those all-time highs has many investors doing one of two things. They're either flocking into the market because, hey, things can only go higher from here, or they are selling everything that they own because they're afraid that the market's going to collapse. And the question is, what is the right course of action? Should you be buying? Should you be selling? And how should you be investing when everything seems to be going up? Well, that's exactly what I'm going to be discussing here, because the reality is we don't know which way the market is going to go, and the worst possible decision that an investor can make is trying to time the market, because the chances of timing the market perfectly are pretty much zero. And just because an investment hits an all-time high doesn't mean that it isn't going to continue to go up. It also doesn't mean that there isn't the potential for it to crash, which is why when it comes to the markets, you should almost always be a buyer rather than a seller, constantly trying to add to your investment portfolio and buying the investments at the times when they are the cheapest. And at the end of this video, I'm going to talk about what you should be doing if you don't already own certain assets and what you should be doing if you already have a portfolio. And spoiler alert, everything I'm going to tell you is to keep it simple. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. Now, obviously, this leads us to a conversation about gold because there is so much attention being given to gold as an asset class right now. It continues to break new records, and because of the uncertainty in the markets due to recent inflation and all of the things that are going on worldwide, including the BRICS nations buying up large amounts of gold so that they don't necessarily have to trade in US dollars, well, that has created a frenzy. And the mistake that people make when there's a frenzy in the investment market is they tend to flock towards it, not knowing whether that frenzy is something that is sustainable or something that is going to come crashing down at some point in the future. And while it may make sense that gold is going to continue to go up and up and up, the reality is it doesn't actually do that. In fact, even though gold as an asset class has a low correlation to the stock market, it doesn't mean that it isn't susceptible to large fluctuations. And while many people suggest that gold is a very safe investment, that it will hold its value over time, the reality is that isn't always true, which is why it's so important to do your research when it comes to making any investment. And that means not just looking at the information that you have found that makes it seem like a compelling investment, but also actively seeking out the opposing views when it comes to those investments. Because, for example, if you're to look at a chart going back in history, it would seem clear that gold is an investment that continually goes up in value. And you wouldn't be wrong. Gold has consistently gone up in value. The question is, has it gone up in value and actually maintained its value over time? And while some people suggest that this is absolutely 100% the truth, the reality is that it isn't. And furthermore, the reality is gold isn't actually a super safe investment. Yes, it is a hedge against the stock market, but it is an investment that can fluctuate just like any other investments. And even though pretty much everyone suggests that gold will maintain its value and hold value relative to inflation and the stock market and everything else, when you actually adjust the price of gold over time for inflation, the reality is completely different. This, for example, what I'm showing you on the screen, is a gold chart going back to the 1950s that is adjusted for inflation. And way back in 1980, gold hit an all-time high, which had many people flocking towards the investment. And then all of a sudden, pretty much overnight, it lost a pretty significant amount of its value. And ironically, if you had bought gold in the 1980s, like my parents and my grandparents did because they thought it was a good store of value, you would have actually ended up having an asset that relative to inflation did not hold its value. In fact, gold relative to inflation, if bought on January 1st of 1980, has never fully recovered. So in other words, if you had bought this as an asset 44 years ago, not only did it not maintain its value, but it's never fully recovered, and you would have spent a pretty significant amount of time well into the red relative to inflation. Now, to put this in perspective, if you would have invested in the stock market at the same time, well, you can see that your investment actually would have fared fairly well, especially relative to inflation, because this is the S&P 500 adjusted for inflation in the exact same way that we adjusted the gold chart for inflation. Now, that doesn't necessarily mean that you should have chosen stocks over gold, but what it does mean is that if you would have owned both, you could have hedged your risk. And that's why when it comes to investing, having a diversified portfolio is so important. You don't want to choose just one asset class. You want to choose multiple asset classes, continue to invest in them over time. And then if you did buy gold, for example, at the peak, well, then at least if you're invested in other assets, you've got those other assets to counterbalance the, let's be honest here, very poor performance of gold. And by the way, stocks don't always outperform gold, which again is why you want to have both in your portfolio so that they counteract each other. Because if you had invested in both stocks and gold back in the year 2000, well, the gold relative to inflation would have performed better than the stocks. So, what's the point here? The point is, you don't know how any asset class is going to perform over time, and you definitely don't know how it's going to perform over the time horizon that you have, whether that's 10, 20, 30, 40, or 50 years. So, instead of trying to pick the best stock or pick the best asset class, what you need to do is create that well-balanced portfolio and always be a buyer of everything in that portfolio, maintaining the percentages that you set out at the beginning. So how this might work, for example, is you may create a portfolio made up of gold, stocks, and bonds. And you may choose to have 10% gold, 40% stocks, and 50% bonds. And then what you would simply do is continually be buying the asset that is out of weight. So, for example, if gold and stocks go up in value and bonds go down in value, well, you start buying the bonds to add them to your portfolio. And then let's say bonds start going up in value and gold and stocks come down, well, then you start buying those. And if you are always buying the assets that are undervalued relative to the other assets, you are buying them when they're on the cheap, and you're doing it without emotion, knowing that over time, all of these assets are probably going to perform okay. They're just going to perform differently at different times. So a lot of people think that I am completely and 100% anti-gold, and that is simply not the case. I still maintain 5 to 10% of my portfolio at any given time in gold. But I also buy stocks, I buy bonds, and I buy other commodities so that my portfolio is always balanced. And when I am buying, I'm getting a good deal relative to other assets all the time, and I'm always consistently investing without caring about the price, caring about whether it's the top of the market or the bottom of the market, because the reality is, I don't know, nobody knows, but I do know that if I'm always buying, I will end up having a portfolio that is worth significantly more than what I put into it. Now, that being said, the way I purchase my gold is using ETFs. The reason why is because they're cheap to get in and out of. Unlike physical gold, which can be expensive to get into and expensive to get out of because you have to pay premiums to dealers, the ETFs just work for me. But I'm not saying that you shouldn't own physical gold either, because if you do believe that there is going to be an event where you have to have little gold bars in order to pay for the things that you want to buy, then fill your boots. But just don't choose gold as the only investment that you're going to make, and definitely don't put all of your money into little gold bars without investing in other things, because if in fact it is the top of the market for gold, you could find yourself in a scenario like those people who bought in 1980 with an asset that never really recovers. But if you balance your investments, so you're buying a little bit of gold, you're buying some stocks, you're buying some bonds, and you're diversifying your portfolio, well, then you don't have to worry about whether it's the top of the market or the bottom. Oh, and if you want to see my video, which has like 800,000 views on why I don't think you should be buying physical gold because of all of the issues I mentioned previously and a whole bunch more, make sure you check out this video right here.